Hi, my name is Stuart and welcome to the Investopoly podcast. Our goal is to share easy to understand evidence-based holistic insights to help you master the game of building wealth. Okay, let's get into today's episode. First question is from Ian, and he writes, my wife and I each have $150,000 carried forward capital loss from a failed property investment, overpaid at the top of the Melbourne market in 2014. So 150,000 each, 300,000 capital loss. We're now in our early 40s, both earn around 350,000 per year. Family home is paid off with 1.5 million sitting in offset account. Super is 600 plus 500,000 in ART. Balanced indexed 600,000 in an ETF portfolio in joint personal names, equally split between cap weighted and factor weighted. We're dollar cost averaging into this portfolio at the rate of 20,000 per month. Kids are 5, 10 and 12, and elderly parents with some taxable income headroom. Well, firstly, Ian, bang, that's you're in a fantastic financial position. I like the fact that you've got, you've been diversifying from traditional market cap weighted indexing, which I've been talking about. ARTs performed really well from a investment earnings perspective, so looks like you're doing really well. Well done on that. Okay, so here's Ian's question. Would a family trust make sense for us? Our thought process is to use the carry forward losses to defer the costs associated with the advice and running a trust. Once we reach a point where the accumulated capital gains from the ETF portfolio equal the carry forward loss, we would seek advice, set up a trust, and transfer ownership. Am I missing an opportunity by not seeking advice sooner? The scope doesn't seem huge right now, but has potential down the track. And would you invest any differently to make better use of the carried forward capital losses before inflation eats them away? Okay, so they're good questions there, and you could keep investing your personal name only to transfer those assets down the track, and you could do them off-market transfers, so you're going to avoid any brokerage fees and so forth. Not that they're substantial these days, but just in order to crystallize that tax benefit. But that's sort of using a capital loss. It's sort of like going about making a mistake just so you can use that capital loss. I'm not sure I'd take that approach. I think if you were our client, I'm not saying this is advice. That's never advice in this podcast. I should actually point out it's always just information only because we don't have all the information necessarily. All we've got is in Ian's question. But I suspect that if I was looking at your situation and you asked us for advice, I'm not sure I would move the existing 600,000 ETF portfolio, but I would certainly consider what to do with the $20,000 a month. $20,000 a month is a considerable amount to invest. And so there's two things that you want to do. You certainly want to make sure that you're investing that in a way today that is going to maximize the returns over the next 5 to 10 years. Now, of course, we want to maximize returns longer than that. But by that, I mean, if I'm investing new capital every month, and I do, I think not only for myself and for my clients, I want to put that in the most attractive option. And the most attractive option for me is what is trading at a reasonable or even below fair value price. And is it an otherwise good index or exposure to hold? So I'm not just doing it just because it's cheap today, but I'm going to buy it because it's cheap today. And even if it wasn't cheap, and it was at fair value, I'd be happy to invest in that for the next 10, 20, 30, 40 years, or even the rest of my lifetime. So it's got to be fundamentally sound and it's got to be attractively priced. And so that's how we approach, regular investing. And the idea is that the returns will revert to the mean. So what we're doing is we're reducing portfolio risk because we're not buying assets that look overvalued or might have a period of underperformance. The chances are the next 5 to 10 years returns are going to be better than average. And that's been certainly our experience with this strategy. And in the long run, it also provides for, any underperformance, not underperformance, relative underperformance, but just general underperformance in the share market. So Ian's investing $20,000 a month, $240,000 a year. That's $2.4 million over the next 10 years. The decisions with respect to how he invests that, not only the next 10 years, but certainly the next 30 years, to my mind, is really clear. In my mind, there's a huge difference delta between doing poorly versus doing okay or as good as, someone with less experience might expect versus doing really well. The difference between those three scenarios is huge, right? I know mathematically, even just a small difference in returns compounding on a very large number results in a huge dollar value difference. And Ian, as he said, he's in his early 40s, so it's potentially got 10 or 20 years of investing in this way makes a big difference. So that's the first thing that kind of jumps out me in terms of, do you get advice now or do you get advice later? I think that there's really a sound basis for having a conversation about that now. I'm not definitely saying absolutely you should do it now, but certainly there is merit in having that conversation. And then with respect to ownership structure, well, look, if the plan was to invest $20,000 a month for the next few years, even say the next 5 years, put it in a family trust. Because what I tend to want to see to justify having a family trust is that the portfolio is going to get to $1 million within 10 years, either through just aggressive contributions or through investment returns. So it sort of depends on what is my starting balance and how much I'm going to add over the next period of time. So in Ian's situation, we can tick that box. And then the other, I've shared this observation experience before, but the other thing is, I've regretted, I think, of the clients that I've had for 20 years, there's some of them that we've got investments held in personal names. And if I had my time again, I would have put it in a trust. So sometimes we can be too focused on keeping things simple, minimizing expenses. And sometimes that over focus, results in not a suboptimal outcome. So I might just share that sort of experience from that perspective. So I think I'd probably put the 20 grand a month in a trust. I'd probably keep the 600,000 ETF portfolio. And I don't have really enough information to form a view of what I might do with that over time. But equally, I could probably, or conceivably, I could probably keep it in personal names and then maybe even, move it into super over time to maximize the transfer balance cap. The other thing and I'm going to get to the carry forward losses in a second, but the other thing that I see in Ian's situation, he doesn't really have much. Well, he has no gearing and he's early 40s. Now that's fine. And he probably doesn't need it with such a high income. He's going to, I don't know what his long-term goals are, but I'm pretty sure he's going to get there unless they're really exuberant. He's in a really great position. And even if he doesn't contribute any more capital, just returns over the next 20 years is going to get him in a really good position. So I'm not arguing that he needs to add some gearing, but I would say, why not? Why not add some gearing? Because he's obviously got heaps of cash flow, heaps of borrowing capacity. There's no gearing there at the moment. So why not do that? And, that's just going to get him into an even better situation. And, maybe one of his goals is early full or partial retirement. So retirement in the 50s. I think he could still add some gearing and in 10 years time, still have the flexibility to reduce working hours. So that's what I'd explore around that conversation. Do we want to put some gearing in there? And I'm thinking buy an investment property, and knowing that, Ian and his partner his wife hasn't had a great, because they got those carry forward losses, hasn't had a great experience with investing in property. So, we'd have to sort of talk about that and what went wrong and decide obviously not to repeat those mistakes. Of course, we wouldn't do that, but adding some gearing might really help us work out how we're going to use these capital losses, because of course we need to create a capital gain in our personal name to offset them. So we could use the current ETF portfolio. If you held that for another 20 years, then sold it and made a non-concessional into super, contribution into super, that could be our strategy to utilize those capital losses. I know inflation's eating away at them, but at the end of the day, it's a crystallized loss. I wouldn't be putting any weight on trying to utilize them as soon as possible. It's just really having an idea how we can utilize them. And if it's not that, then maybe it's gearing in personal name with property, because that would seem not only a sensible thing to do given age, stage, asset position, all those sorts of things, but also from a capital utilization perspective. And then we've got sort of plan A, plan B. We can either sell the property that we're going to use the capital losses, or sell the ETF portfolio gradually and get that into super, whatever that might be. One thing I forgot to read the last sentence of Ian's question. He goes, it doesn't seem like the right time to be tilting towards growth. For Ian and anyone in Ian's position, really difficult. That might be true. It might not be true. I guess if you don't have, a coherent long-term plan, you understand where you're heading, that comment is just sort of sits in nowhere for me. I've got no way to benchmark whether we should be going more high growth or lower growth or more conservative as well. So that's the other thing that I think kind of adds to the basis of having that discussion in terms of whether you need advice now. Because again, if you have that plan and you have that context, and in fact, going all growth now is in fact, the best approach, then better to work that out now today rather than, look back in 20 years' time going, well, we could have done more, we could have had gearing, we could have done something else. You only need so much money, of course, to have surplus monies is not necessarily going to change your life. But I mean, these sorts of things are the sort of things that you should or you could explore. And that long-term plan gives you context for making those decisions. Okay, thanks, Ian. Thanks for your question. I hope that answer makes some sense. Okay, next question is from an anonymous listener, or listener wants to remain anonymous. This person writes, my wife and I are in our late 40s, in fact 48 to be exact, and we hold 3 residential investment properties in our personal name. One in my name, one in my wife's name, and one in joint names. They're valued at $2.5 million in total at approximately 60% loan to value ratio. Plus one commercial property in a family trust. 1.2 million is the value with about 90% loan to value ratio, 825,000 in combined super, 350,000 in cash in offset accounts. The listener earns 220,000 and wife 30,000 working part-time, which won't change. And they're maximizing super contributions. Oh, sorry, I'm maximizing, so only the husband is maximizing super contributions. They've also got an ETF portfolio, 120,000 in ETF held across GHHF, which is the geared beta shares, sort of global or high growth, I should say, VDHG, VGE, and VDGR. That's a mouthful. So all good ETFs there. There's no issues there with those ETFs or holdings from my perspective. And then we plan to invest 50,000 initially from the cash reserves later this year, which was last year, because I'm reading this question was received in November, and then $1,000 a month dollar cost averaging over the next 10 years as we build some diversification from property exposure. Okay, so the question is, given our long-term-ish horizon, moderate to high risk profile, and existing ETF holdings, what type of ETFs or ETF mix would you consider appropriate for investors like us to diversify beyond property and steadily build a long-term portfolio? Finally, should we hold an amount of $50,000 to wait for a market dip and buy a larger sum then? Okay, well, it's a good question. I have in the past received questions around portfolio construction. This is what this question relates to, is which ETFs do I invest in at what stage? Which is going to be, I'll give you the answer today, which I will. I'll at least hint at the answer today. But I think what's better is just to talk about what the long-term approach is. So firstly, listener said, I've got a long-term time horizon. That's really important in terms of making sure we make the right decision today. So, I mean, the best question you can ask yourself, and I say this throughout the book Investopoly, is, what can I do today so that in 10 years' time, I'll look back and go, gee, that was a great decision. And really, when we're building dollar cost averaging, building an ETF portfolio, that's the thing that we should ask ourselves. In 10 years' time, if I look back to 2026, which ETFs will I be really happy I purchased? And the benefit of taking this approach is that it forces you to make longer term decisions rather than, because in 10 years' time from now, you're probably not going to really think about what Trump said in February 2026. Maybe will, I don't know. Maybe the legacy will be far reaching. Who knows, but you're probably not, right? The point is that the headlines, the topics that dominate the headlines today probably aren't going to be on the radar 10 years' time. And that's what I like about that question. The listener says they've got a moderate to high risk profile. I don't, just as a general sort of rule, I tend to ignore comments like that. No offense to the person that wrote in, of course. Look, I would describe everyone's risk profiles probably the same. Like I would describe my risk profile as in, I don't want to take high risk. I've I've really got no appetite to lose money. That doesn't excite me at all. And I just want to earn the maximum return. In fact, I'd like to earn 10% per annum over the next 10 years. Let's call it 8 to 10% just to be reasonable with it in terms of ranges, because markets do change, of course. That's something I can't control. So I'm happy to earn 8 to 10% over the next 10 years, and I want to take as little risk as possible to achieve that goal. That's how I would describe my risk profile. And I think a lot of people would go, yeah, Stuart, that sounds fine. Like, I'm happy with that. If you get a 10% return, actually, if you get 7.2%, you're going to double your money over 10 years. If you double your money a couple of times, over a 20-decade period, that tends to be enough for most people to generate a lot of wealth. In fact, if you do that, you're going to be better off than probably 95% of other investors. So that's, I think, the risk profile. So I would say my risk profile is medium to low, to be honest. I'm happy to invest in growth assets. I'm happy to invest in assets that have higher volatility like shares. There's no problem. I don't see that as risk, but I don't want to lose money. I don't want to risk that I'm only going to earn 3% over the next 10 years. That's what I want to reduce as an investment risk. And now here's a traditional portfolio construction approach. It's to have a look at what exposure you have and what exposure you don't have. So what are you overweighting? What are you underweight? And then to build out a portfolio so I can then introduce the stuff that you're underweight in, to have a more balanced kind of profile. Like, that sounds like a lot of words. I don't know if I made sense explaining it like that, but that's kind of the traditional way. That doesn't really make a lot of sense to me. Like, I would rather invest most of my money in something that, in a geographical market or in a type of indexing strategy or methodology that is the most attractive now. And if I put all my money into that, you might say, Stuart, that's balanced, and I'll give you an example in a second. That's really unbalanced. And it's true. But, if I return back to my risk profile, which is, I just don't want to underperform the market, I certainly don't want to lose money, then isn't putting all my money in a sector that I think has good long-term fundamentals, that has had a proven long-term track record, but is very attractively priced today, isn't putting all my money in there the least risky thing I can do? Like, that's the thing I look at. That's the way I look at it. So to this listener's question, my answer is very long and rambly, but to this listener's question, my answer would be I don't really care what your existing holdings are. I mean, they look good and I don't have any problem with them. But really, when I'm thinking about additional investments, I'm thinking about which part of the market is most attractive to me. Okay, so that's a lot of rambling, Stuart. Just give me the answer. If I was listening to this podcast, that's what I'd be thinking. So anyway, I'm talking to myself now. Look, I'll give you some examples. So if I was going to invest today, I invest every month. So if I'm looking at an investment opportunity today, the thing I'll think about is, okay, the US markets, not the whole market is pretty heavily, overpriced, but certainly the large tech companies are. Some of them are justified, but, there's a lot of risk there, concentration risk, all those sorts of things. And as I discussed last week about the AI trade, there's some are going to be winners, some are going to be losers. We just don't know which ones are. So there's a bit of risk there in the market. I would look to outside of that. So, I was looking at iShares Europe ETF, and the ticker code is IEV. I was actually just looking at that one on the weekend. The return in 25 calendar year was 35%. Yeah, that's right. And the 3-year return's 18%. The 5-year return's 10%. This has really shot the lights out Europe, and it really gives you exposure to the UK. And I've spoken about the UK before. It is the best performing developed market in the world over the last 5 years, slightly better than the US. It's got 15% in France, 15% in Switzerland, 14% in Germany, and then most of Western Europe is in there as well. And you have a look at the index's PE ratio, it's 18.75. It's a healthy PE, but it's not a problem, especially when you compare it to the S&P 500 PE ratio, which is 30.5 times. So you can see why that one looks attractive. So I think Europe looks pretty attractive to me as a developed market investment opportunity. And then VanEck has a multi-factor emerging market ETF. Its ticker code is EMKT. Its performance has been really strong as well. 28% over the last year, 23% or nearly nearly 24% over the last 5 years and 24% over the last 3 years, and then per annum, and then over 13% over the last 5 years. So pretty strong performance. And so you look at its index, the PE of its index that's tracking, it's only 11 times, which is ridiculously low. So its emerging markets are still really cheap. There are two examples. Certainly EMKT is, I think, more attractive than IEV, but I think they're both attractive for different reasons. One's developed markets, one's emerging markets. So one's going to have a higher volatility than the other. But they're two examples, I think, that to this listener's question are the sort of approach that I take. And let me put it this way. Now, this is extreme, right? But if I was in this person's situation, I'd prefer to put 50 grand into EMKT. I'd feel pretty comfortable with that rather than spreading that 50,000 just across a broad-based market cap global index, for instance, just because I think mean reversion is going to help and all these sorts of things that I've just spoken about. Now, that's the way I think about investing. That's the way I think about building a ETF portfolio or a share portfolio, managed fund portfolio that I think reduces risk and exposes the portfolio to higher returns. Now, if you don't have the skill set and knowledge to be able to pick those ETFs, that's fine. And if you're investing $1,000 a month, that's okay as well, because you've got a bit of margin for error in that, if you earn 10% or 9% or 8%, it's probably not going to move the dial very much on those sorts of numbers. But compared to, the previous question, I think it was Ian, where he's investing $20,000 a month, that is definitely going to move the dial. So, in the absence of something else, you'd either go emerging markets or developed markets, but maybe also you could alternate between, say, Europe and Kuwait, US would be okay. So that's QUS. Look, it's going to change from time to time. The general themes, don't change necessarily monthly or quarterly, but they do change from year to year. And so the way you'd go out and build a portfolio is going to be different. That's why my answer's been very long and long-winded, not only to answer this listener's question, but hopefully anyone that's listening that's kind of, a lot of people are building out ETF portfolios themselves. So it'd be great if I could say, well, buy these 10 ETFs, each month over the next 3 years or whatever. That would be nice, but, that's not really the answer, and I can't really give you that answer. So anyway, I feel like I'm rambling now. I'm going to leave it there. Hopefully that helps people kind of understand our approach to investing, or my approach to investing, and understands where that nuance is in terms of trying to reduce portfolio risk and achieve better returns. Okay, next question is from David about asking whether it's wise to upgrade his primary place of residence. David and his partner, no kids, they're 45 years old. Let's just assume 15 years away from retirement. I don't know, but let's assume that. By early 2027, so in a year's time, they would have repaid their home loan. They've got a nice townhouse, 5Ks from Brisbane CBD, worth about $900,000. In terms of investment assets, $1.1 million in diversified ETF portfolio, $750 in super, and they contribute about $2,000 a fortnight into super. And they'd like to be in a position to retire early. Okay, I should have read ahead. Retire early in 9 years' time, and they estimate they need about $75,000 annually for expenses. They'd like to upgrade their home, but they just wonder if they've left that too late and whether that's going to compromise retirement. To upgrade their home, they're going to have to take on $500,000 of debt. Well, David, the thing that I'm missing is your income. That's a pretty important aspect to it to be able to answer the question. Let's put it aside for a second, though, because you've got 1.1 million in ETF portfolio and 750 in super. So I can understand why you've got so much outside of super, because if you want to retire in 9 years' time, you'll be, say, 54. So you've got 6 years to fund before getting access to super, hence the large ETF portfolio. So 9 years, let's round up to 10 just to make the maths nice and easy. 7% return. You've got your portfolios now north of $2 million and super about $1.5 million. Another 5 years for super, maybe it's $2 million in total. So, you don't have to do much right now as long as you don't do anything wrong, which means that, as long as that ETF portfolio is actually going to perform as and achieve 7% average return, you're well on track to be able to achieve that. So when I look at your situation, I don't think additional capital contributions are necessary to make your strategy work. It's really just about performance of those existing assets. Therefore, if you have a look at your income and have a look at what's left over. And if you think you can repay that $500,000, even if it's not $500,000, even if it's like 400,000 over the next 9 years, by the time you want to get to a stage where you can retire, and you only make minimum, just the standard SG contributions, super contributions, then it's achievable. It's likely achievable. Again, this is not advice, it's only information, but just looking at those broad numbers, I don't think you're sticking your neck out by doing that. Look, the other thing too, you've got to realize that, when planning, you've got to balance out a lot of different factors, and being in a home that really maximizes your enjoyment is fundamental to that. I've had some clients, I remember one comes to mind, and just wasn't happy with his home, and he ummed and ahed over it for a long time, and recently sold and upgraded, which he might have been better off doing, many years ago. But the place we live in terms of its aspect, its livability, the size, natural light, quiet enjoyment, as this David said, I like gardening, these sorts of things, that adds a lot to our standard of enjoyment in terms of life. And particularly if we're going to go into early retirement, maybe we get more time to do more gardening and things that we enjoy. So making sure you've got the assets to do that is really important, I think. So we can't underestimate the impact of that. Now, if you say to me, look, Stuart, we can take out a $500,000 mortgage, but we can't get, close to repaying it. So, if you can only repay half of that debt over the next 9 years or whatever, well, then I would ask you, what's your priorities? Would you like to do this upgrade now, knowing that there's a 50-50 risk that you can't retire at 54, you might have to work to 56? Or is that 54 goal absolutely hard and you would much prefer to stay in your current townhouse and retire at 54 than risk not being able to do that? And depending on your answer to that question, then, if there's any sort of variability, then we could potentially go either way on it. But I think you've done all the hard work in terms of getting your asset base in a great position. Compounding should now really pick up and do most of the heavy lifting. So it's not really relying on your capital contribution. Of course, any more capital's good capital. And I would try to encourage you to prioritize getting a place that's going to add to your overall enjoyment of life, because you're going to spend a lot of time in that property when you retire in 9 years' time. So it may as well be a really good one. David, thanks heaps for your question. I hope that answers it. Okay, I'm going to squeeze one more in. It's from Daniel. Okay, I'll give you a bit of a rundown of Daniel's situation. He's 35, wife is 36, 2 kids, 6 and 5. Likely go to public schools, may consider private. Live in Western Australia, home's worth 1.2, fully paid off. 250 ETF portfolio in a family trust structure. Good on you, Daniel. 100,000 cash in a high interest saver account. Super is 200 plus 120. 120 is obviously the wife. No debt. A household income of 230,000. And Daniel's maximising concessional contributions, so 30 grand a year. No plans to change the home, just do some renos, and main possible large expenses, building a pool in 2 to 3 years' time. If I lived in Perth, I'd definitely build a pool. We have jokes about, in the office about having a pool in Melbourne. You'd probably use it no more than 3 or 4 times a year. Unless you have really young kids, they can be crazy and jump into really cold water, but for most people. But if you lived in Perth, you'd use it almost probably year round to some extent. Daniel's currently investing $2,200 per fortnight into the ETF portfolio. He writes, don't have a corporate trustee. I think he means corporate beneficiary, as he distributes to his wife and then eventually to the kids when they're 18. Daniel's goal is to hopefully go part-time at 50, 55, and they would be happy to continue work part-time until 65, 70. And so here's his questions. Is $100,000 too much to leave in a high interest saver account when we have thoughts of a pool? So just for context, I normally like to have 6 to 12 months of commitments or living expenses in cash. So I don't know what Daniel and his family spend, but that's probably pretty close to 12 months of living expenses. I'm kind of happy to hold more cash because my answer is going to link into my answer to Daniel's next question. But arguably, the larger the cash buffer you have, then maybe the more open you are to taking more risk with, borrowing or investing or so forth. So no, look, if you had $500,000 of cash, I'd say that's too much. 100 grand I can live with. I think having a nice, safe amount of cash, personally would make me feel comfortable. And so I guess it depends on your risk profile, but I'm happy with it. I don't think, and particularly a high interest saver account's not going to earn that much money. But what you could do is put it in an ETF that's going to be relatively capital stable. So Daniel, at the moment we use SUBD, SUBD. It invests in subordinated debt issued by the big banks, so very safe from a default perspective and so forth. And that'll earn sort of 5.5% to 6% linked to the cash rate. Of course, as the cash rate changes, your yield will change, and it pays monthly in terms of the distribution. So really that's the best kind of at call, if you like. It's not at call because you've got to sell, you've got to wait 3 days for your shares to settle, of course, but it's pretty much at call linked to the RBA. So, you're not going to get the banks playing around with the margins, as in when the cash rate rises, they don't always pass it on to deposit holders as well. And that's just a better way to make that cash work a little bit harder for you. Again, I suggest that you have a look at. That's not advice, but have a look out for that one for cash holdings. And at least say, earn 5.5%, 6%. So it's not lazy, it's not doing nothing. And, I'd probably have that in the family trust in terms of your cash. So you could put that in sub D in the family trust, and therefore you can distribute the income at the end of the year in the most tax effective way. Okay, next question is Andrew's question. It's a segue into, as I already hinted, should we consider buying an investment property? He says, going back into debt worries me. We've been having pretty cruisy, having worked really hard at just repaying our home loan. I've actually fully repaid the mortgage, so I shouldn't have done that because I could have redrawn to do debt recycling. It's not an option for me. Okay, so I wrote a blog, it must have been a while ago, I can't find it, and it was about one of the key themes in that blog was that it can be addictive. Saving can be addictive. Reducing debt can be addictive. Telling yourself you're now in a much better position from a risk profile because you've got no debt can be a really compelling story for yourself. And you just got to be careful about that, because certainly saving and reducing debt does, as a general rule, increase the strength of your financial position, and as a general rule is a good strategy to do, but not at the extremes. Like anything, it's not at the extremes. So I think if I speak to sort of Daniel's viewpoint here, in like, I'm just not that keen to get back into debt. I hear you, but you've got to ask yourself, what is the most sensible financial position to do right now? I'm not against putting more money into super, of course, but you're 35, so you're a long way from being able to access those monies. And if you'd like the flexibility to retire at 50, then that's not going to help you either. Also, if you'd like the possibility of retiring at 50, then buying investment property now gives you 15 years for that property to do its thing. So by 15 years time, it might still be negative cash flow, even if you borrow the full cost and only ever repay interest. It might still be negative cash flow, but it won't be that material. And actually, in the next 15 years, if you put a little bit of money in the offset account, you can easily, without being too aggressive with debt reduction, you can easily get it to the point where it'll be neutral cash flow. So it's a perfect time horizon to be able to get into the market and buy an investment property. If you were 45 and you wanted to have the flexibility to go to part-time work by 50, 55, I would say now you're cutting it too fine to buy an investment property because you don't have that time. Because obviously the interest cost will be, the interest rate's going to change, but let's say interest cost at 6% is actually going to be declining each year because CPI inflation eats into it, whereas the rents should keep up with inflation or probably outpace it. Particularly in Perth over the recent number of years, it's certainly been doing that. So in actual terms, your costs are relatively steady and your income is increasing, and that's why eventually the property will get to being positive cash flow. So, and then the other thing too here is that the way I look at it is to say, buy the investment property, get as much into super, and then by the time you get to 50, 55, all you need to do is work enough just to cover your living expenses. And even if you've got a small shortfall, that's not a big deal. Meanwhile, your super is still compounding. You've got the investment property equity and the investment property compounding. I think it makes a lot of sense. So that's what I would do in your situation. You haven't really spoken to surplus cash. Oh, you do actually, to 2,200 per fortnight. So you've got enough money to, and you don't have any gearing at this stage, which is not ideal for someone in their 35 in terms of what's the best steps to maximize financial outcomes. So look, I would probably think the next best move for you is, yes, buying investment property, and I would just caution you about sort of being sort of over conservative with borrowings. But of course, you need to feel comfortable, right? Next question from Daniel. He says he's got 70,000 catch-up super contributions. Is that something I should consider taking advantage of? Well, the thing is, you can go back 5 years. So my question would be, what's the catch-up contributions you're going to lose today? So if you go back 5 tax years, let's say the concessional cap back then was 25,000. I'm just going off the top of my head. I haven't looked this up, and you made 20,000 of contributions in that year, then you've got $5,000 of catch-up contributions that relate to that particular year. If you don't make it in the 26th year, it'll disappear. It'll go off because you can only go back 5 years. So that's the first thing I would look at is what are you going to lose this year? If it's $5,000, then I'd make it. I'd utilize that cap, and I'd just consider that from year to year in terms of what are your priorities, what are your expectations, any changes in income, all that sort of stuff, and make the decision that way. The other thing to consider, not related to Daniel's situation because he's not close to that balance yet, but the other consideration is, how much super do you have? Because the eligibility to use catch-up contributions is for people that have a total super balance of less than $500,000 at the beginning of the financial year. So if I have a client that say had 480,000 at 1 July 25 and their balance is already north of 500,000, we've got this is our only year to make those catch-up contributions. So I then think about that sort of take it or leave it situation in that particular year. So that's how I would address catch-up contributions. At the end of the day, it's about making the best long-term decision. So for example, should I buy an investment property or should I put 50 grand into super? Well, which one do you think in 10 years' time is going to put you in a better position, 20 years' time, so forth, that long-term approach. Anyway, Daniel, I'll leave it there. I hope that answers your question. And sorry to everyone that's listening for going over. I just wanted to get through a few extra questions today. We've got a ripper of an episode, not we, that Campbell has a ripper of an episode tomorrow. I've spoken about this previously, that he's been working on it for quite some time. And it's really testing the thesis around splitting your money across the Australian and international share markets. And that's really been the general consensus and theme in traditional portfolio construction, really in Australia for a long period of time. You look at the industry funds, that's what they're doing. And we wanted to test that conventional wisdom. We don't want to be different just for different sake, but we think it makes a lot of sense to take an evidence-based approach to all these sorts of decisions and really test whether that makes a lot of sense. He's got it's a very interesting episode, so I hope you look out for that one. So for me, until next week, bye for now. And before you go, if you enjoyed this episode, please share it with someone that you think will get value from it. And if you have a moment, leave a rating or review on Apple Podcasts or Spotify, as it really helps more people find the show. If you have a question you'd like me to answer in the next Q&A episode, email it to questions@investopoly.com.au. And if you'd like to learn about my new book, Wealth by Design, which is out in a few months' time, head over to investopoly.com.au/book. The link is also in the show notes. And you can also register for the pre-order offer, which is an AI tool that you can use to get more personalized value out of this podcast. Thanks for listening.